Good evening, everyone, and welcome to the webinar. Before we get started to our webinar, I would like to introduce our speaker as well as please note that this is a recorded session, and towards the end of this webinar, I would be sharing a Google form wherein which you can rate the webinar as well as you can fill in the details for the purpose of getting the recorded session of this webinar. So without wasting much time, let me introduce our speaker today, Dr. Sadaf Hashmi. She is an accomplished associate professor in finance with over 17 years of experience in academia, research, and corporate training. Holding a doctorate in finance with a specialization in banking, she blends a strong academic expertise with extensive industry exposure. As an empaneled trainer with the National Stock Exchange, CFA Institute, ICE, and ICSI, and through her work with leading organizations such as Tata, AIA, HDFC Mutual Funds, UTI Mutual Funds, and First Rand Bank. She brings practical insight to her teaching training. A certified SAP FICO trainer and a certified fintech practitioner from LIBF, she is also a prolific researcher who explores the intersections of finance, technology, and innovation. With contributions to journals, book reviews for reputed university and publishers, curriculum design experience, and active mentorship of students to research and entrepreneurs. Dr. Sadaf continues to play a significant role in shaping the finance through education, innovation, and industry collaboration. Welcome, Dr. Sadaf.
Thank you so much, Renu, and a very good evening to all the participants over here. Today, we are going to have an interesting discussion. Yes, it is going to involve a bit of the numerical or quantitative aspects, as you may call it, for understanding that our investments in the financial market, how profitable or productive they are. This is an age when everyone is talking about rare earth minerals. I'm sure you must have heard about them. Okay, so you know that today these minerals have become so important, looking at the kind of development with the electric minerals, like lithium is one of them, uranium is another one. And with the future technologies that we are going to harness and use, these rare earth minerals are going to be very, very important. But can we invest in them? Is there any way that we can invest and make the most of it, or multiply our money or grow our money in the long run? Okay, like you can see, gold, copper, silver, these commodities have become so valuable. Even after all the price rise, even now, it is expected that the prices for gold and silver will be going higher and higher. Also, you all are aware that silver as a commodity is not just a household use product, it is also used widely in the industry, in all our gadgets that we are using, in the electric vehicles that we are using, in any kind of production activity. Silver is a very, very important element. So, today we are going to see and evaluate how we can invest in them, can measure the risk and return. What are the ways? Of course, once you are aware about them, it's not necessary that you may just sit down to churn in numbers and the formulae. Today, we have quantitative models, and a lot of these numbers or a lot of this data is easily available over the internet to various websites. Okay, towards the end, I will even suggest some platforms that you can watch and you can follow to get some updates on the international news, so you know what the trends are like. Because in investment, the whole idea is about knowing the future trends, investing at an early stage in these future trends so that you can maximize your returns. And how do we measure the risk and returns? Today we are going to discuss about this. So please grab a pen and paper, or maybe on your laptops, you can open a Word document. You can keep on making the notes out there. You will be even getting the recordings for this session. So I think that should be helpful to all of you. So let's start. Whenever we are talking about risk, so first let's understand the two categories of risk which are there in any kind of an environment or in business, or which impacts the investments. There are two types of risk, of course. One which can be controlled to a certain extent. One, of course, cannot be controlled. Like in a simple understanding, if we talk about natural calamities, we all understand that natural calamities is a risk which is out of our control. It has financial implications. Okay, like an earthquake or even a volcanic eruption. We have seen in just about a few days back, there was a volcanic eruption in Ethiopia. Does have financial implications, right? So it's important to understand that the risk that a bank faces when the bank gives a loan to any borrower, that particular amount of risk can be controlled to a certain extent because the bank can do the monitoring of that individual, that whether the individual is working, what the salary is, whether the individual has a spouse. So the risk can be shared. And looking at the graph of his monetary growth, they can understand whether this person will repay my loan, this company will repay my loan, or they will default on it. So they can take the measures at an early stage, and to certain extent, the credit risk can be controlled by the bank. But as I said, the risk of the markets on Monday, how the markets would be like, what kind of policies from US or different parts of the world would influence the financial markets, we do not know. And that is where we call them as the systematic risk factors, which are uncontrollable, like your market risk, okay, your environmental risk. These are all the systematic risk factors. International risk, political risk, these last few years have been risk emanating from the geopolitics, the tiffs and the conflicts between different countries, where trade, industry, and so many other things got impacted, right? We even saw that how Russia-Ukraine war led to some devastating impact all across the world. So it was not just the impact on Russia and Ukraine alone, but it was the impact on the entire world that this war brought about. So these are uncontrollable risk. This will come in the category or the bucket of the systematic risk factors. The ones which I can control are in fact just about two. Okay, as I said, they can be controlled up to a certain extent, not completely. One, of course, is a credit risk by a bank, by any lending institution in the world. Second risk is an operational risk. I know, as I said, like, this can be controlled only up to a certain extent. So when I say operational risk, it is a risk today we talk in terms of cyber security, employee frauds, employee scams, or maybe scams by the management, any kind of scams which would impact the business, which would impact the company, which would, kind of completely diminish the reputations of the company in the market. Like today morning, there was this news which came in from Airbus, where there was some technical issue, okay, in the Airbus, and that kind of sent a little bit of jitters across different airline companies because a lot of airline companies are using the Airbus aircraft. That will come in the operational risk. I can control it to a certain extent. Okay, some risk in the processes, some issue in the processes, the people, the cyber security, these all can be controlled, these all can be in some way managed. That is why it comes in the unsystematic risk. Now, why I'm explaining this to you, because for the systematic risk we measure it using a measure which is called as the beta. Okay, I'm sure you might have heard about this term. I will also show you how do we go about calculating the beta. And for the unsystematic risk, we use the standard deviation. So if you're comparing two stocks, you're comparing to investment schemes, you can see what their standard deviation is, which will talk about the unsystematic risk. And you can see their beta, which will talk about the market or systematic risk, how sensitive they are to the changes in the market. Because see, some people might be okay, like, some people are even comfortable investing in cryptocurrencies, right? I'm sure all of you are aware about the very famous Bitcoin, Ethereum, Litecoin, Dogecoin. These are different cryptocurrencies. There are 2 lakh cryptocurrencies in the market now, and we don't know where it's going to go. The beta for cryptocurrency is extremely high, okay, because it is very sensitive to the market. Any country taking any kind of a stand, any kind of news headline, all of this will instantly impact the cryptocurrency. And the volatility is huge. Like it can go from a 35,000 to a 70 to a 90. It can fall down to 20. that kind of volatility is there. So the beta is very, very high. So these are two important things. First, we need to understand what is the spectrum of risk and how we have two measures which can measure the types of risk which are there, certain controllable and some which are uncontrollable. So with this, with a little background, we move ahead to some simple understandings. Okay. In this, we will also see, apart from standard deviation and beta, what are the other ratios that we can use, which are simple and easy to understand as well. This can also be applied to collective investment schemes like mutual funds. Okay, we all know that mutual funds, exchange traded funds are so very popular across the globe. And I'm sure that after you hear this term of mutual funds, the next question or the next term which will come in your mind is the hedge funds. But please remember, guys, mutual funds are for retail investors like you and me. But hedge funds are largely for institutions where they would invest a huge chunk of money. They would invest primarily in very risky investments because if they take a higher amount of risk on their plate, that will lead to good returns or higher returns. And that's what those institutions would require. Like you have insurance companies, people are paying premiums to them, they are investing them in the market, they are multiplying them. But since insurance companies are under pressure to provide a higher return, these insurance companies would choose to invest in a hedge fund. Okay, even you could see a lot of different mutual funds could also invest in a hedge fund. Okay, and hedge fund could not just invest in the investments in their own country, but hedge funds can invest in investments or in stocks and different investments all across the world. Okay, but hedge funds are primarily risky, and more so they are an investment for the institutions, for large institutions. All right. So now with that, let's come to an understanding of what the Sharpe's ratio is. So all these ratios will also give me idea about the risk and return. Always remember these two things go hand in hand when we talk about the investments, when we talk about the financial market. You cannot separate, you can't say that, okay, I want to earn a high return, but I don't want to face any risk. That's not going to be possible. They both complement each other. They both are, attached twins, you can say, to each other. You have to face risk if you want high returns. Okay. So let's see what the Sharpe ratio tell us. So the name of this ratio comes from the person, Mr. William Sharpe, who invented this ratio, where he said he gave a very simple formula. If you look here, it talks about the return on the investment, the RP, the return on the portfolio, the return on the investment. So portfolio can be a collection of different investments all together in one, minus the risk-free rate that we have. Okay. So risk-free rate is what? Now risk-free rate is a certain percentage of rate which the government would provide, where you can invest in certain government securities where you might not face any risk, but that would be very, very low, maybe around 3 or 4% in certain countries. In countries like India, we might have it 5 or 6%. That's very, very low. Okay, in single digits. That's the kind of risk-free rate of return. And that is not even beating the inflation. Okay, the inflation in our economies is pretty high, and we need our money to beat the inflation if we want it to grow and accumulate. So if you're talking about the RF, the risk-free rate, that is just the minimum rate that you are getting. You're not earning any return out there, but that will not beat the inflation. In the denominator, this sigma symbol that you see, this is your standard deviation. So Sharpe suggested that if I want to find out the risk-adjusted returns, that's what he called it, we need to use this formula where we are taking the return on the portfolio, we are subtracting it from the risk-free rate, and the difference is divided with the standard deviation. That gives us the Sharpe's ratio. It tells us that what is the return which is being generated or earned on the portfolio basis the risk the investor is taking. You can even note down this formula. Okay. Yeah, we can share this PDF as well. It's absolutely fine. So this is our first ratio to calculate and understand the risk adjusted return given by William Sharpe. Here is also a simple example. through which we can calculate it. Like the portfolio provides a 12% return, which is a general return in the market. We should get anywhere between a 12 to 15%. That will be good enough to beat the inflation, as well as it will provide accumulation of the capital. Okay. So here you can see that we do have 12% return and the risk-free rate is 5%, whereas a standard deviation, the risk measure is around 10%. If you substitute these values, you will get the Sharpe's ratio as 0.7. Okay, you can compare this with another funds or another portfolio's Sharpe ratio, and you can see that whether the Sharpe ratio of fund A is more or the fund B is more. Now, suppose if a fund is having a higher Sharpe ratio, what do we interpret from that? We interpret from that that the return is higher, because if you see in the numerator, it is a return. A higher Sharpe ratio would indicate that the return is on the higher side. So that is what would indicate, and definitely you would go with the one which is providing a higher return. Obviously, you will keep your risk factor in check, but you would definitely want to go for a higher return. So that's what is mentioned over here. Higher this number, better is the risk adjusted performance. Any questions? You can please put them in the chat box. Now, this was the ratio where we took standard deviation, right? But as we discussed, the standard deviation only measures the controllable risk to a certain extent. It does not measure the market risk. It does not measure the uncontrollable risk. So we need to do something about that, because we are predominantly investing in the market and we do face a lot of market risk. So therefore, Trenier came out with another ratio where he said, no, we need to consider the same formula, but in the denominator, we need to take beta. And that's why you see the Trenier ratio, where you have the same numerator. You have a return on the portfolio minus a risk-free rate, but you divide it with the beta of the portfolio. And generally, you would see the beta would be in a range where it could be less than 1 or more than 1. A beta is generally in that range. It's not like extremely high, like 10, 15. It won't be like that. It will be like less than 1. You can even have negative beta. That is also possible. And it will be slightly above 1. That's the kind of range for beta, which will cover the market risk, which will cover the systematic risk. All right. So this is the next formula, which talks about the Trenier's ratio, taking into account the uncontrollable risk factors. Just the same formula, only denominator has beta. Let's look at an example. Now, in this case, say the portfolio is providing a 14% return, the risk-free is 6, and the beta is 1.2. Substituting them, you would get the Trenier ratio of 6.67%. And obviously, in this case also, the higher the Trenier's ratio, higher would be the returns which will be generated by the mutual fund, by the investment. And therefore, you would prefer the fund or the portfolio which is providing the higher Trenier ratio, higher Sharpe ratio, and the higher Trenier ratio. This is what you will choose for the purpose of investment. Okay. And also we can see that the higher Trenier ratio would perform better than the market benchmark that is there. Like it would outperform the market indices which would be there. Like different countries would have different indexes. Like in US, we have the Dow Jones, the S&P 500. Every country would have their index, which is based on the stock market of that country. So generally you should outperform that. Then we would say the performance is good and noteworthy. Then is another aspect that we're looking at to measure the returns. Returns, the excess return that a fund or an investment can generate is called as the Jensen's alpha. Now, Jensen's alpha, if you see, is taking into account again beta, but it talks about, if you see the bracket towards the end, it talks about the equity risk premium. Okay, like what do you mean by equity risk premium? What is that additional risk I am taking for investing in this security, which is rewarding me, which is giving me a high return? So it is a market return minus the risk-free rate. This is what is the market risk premium, talking about Jensen's alpha, and the higher the Jensen's alpha, the more it is beating the market, the more it is providing a good return for the investment. So again, you can choose investments with a higher Jensen's alpha, and this is how we would have the formula go. Also, RF plus beta, RM minus RF. So RM refers to the market return. What is the average return in the market minus a risk-free rate? And that this formula in the bracket also stands for a formula which comes from the capital asset pricing model, CAPM. That is also one of the theories or models which are used in the financial market. We take this into consideration, we minus it with the return on the portfolio, and we find out what is the Jensen's alpha, what is the excess return which is being generated on this investment. And through that, you can understand, like if it's negative, there is no excess return, you should not invest in this particular portfolio, you should not invest in this fund. You can even see the history that, maybe there is a market correction and now the alpha is negative, but in future it's quite possible, or if the history shows that, yeah, it has been providing a good alpha, that could be a good entry point into the investment. Okay, so Jensen's alpha, very simple and easy to understand and compare, where we could look at what is the excess return which is being generated, because everyone wants to invest and get a good return, right? So the answer to that could be Jensen's alpha. Let's look at an example. So here you have a portfolio earning 15% and the risk-free rate being 5%. Market return is 12, the beta is 1.1. Substituting all in the formula for Jensen's alpha, we get the alpha as 2.3, which indicates that this is the 2.3 is the excess performance, is the additional performance higher than the market. Okay, more than what the market is providing. So you can compare 2, 3 investments, whichever gives the highest Jensen's alpha, you can certainly go for that. All right. So these were the 3 measures we discussed till now. Sharpe's ratio, which used the standard deviation to find the risk adjusted return. Trenier's ratio, which used the beta to find the risk adjusted return. Then we had Jensen's alpha to find the excess return, okay, which definitely used the difference between the market return and the risk-free rate. Now, this is specifically for funds, okay, for mutual funds, for different funds that you are investing in, which is called as the information ratio. And sometimes, because if the market movements, there could be a slight tracking error. There could be a slight change in the price or the values, which may not be very accurate. So this is the information ratio, where you have the portfolio return, the benchmark return, and you divide it with the tracking error. Okay, so this could be an information ratio helping us to understand, again, some additional return, but adjusted for any tracking errors, adjusted for any reporting errors, because the prices change so frequently in the stock market that it may not be possible to accurately absorb all of them. The example for this, say the portfolio earns 14%, the benchmark is 10, and the tracking error standard deviation is 4. So there's just a 1% or a 1 unit additional return which has been generated. And higher this number also would mean that the higher return is being provided. See, wherever you have return in the numerator, always the premise would be that the ratio has to be on the higher side. Okay, always remember that. So this is for the information ratio. Now we're talking about returns, but we also know that there is a downside. We even call it as market corrections, and it could be various reasons, as we discussed, some geopolitical issues, some tariffs by the US economy, maybe some other disturbances in the manufacturing, in the industry, which would impact the market. So what is the downside risk? How much is a downside risk? What is the downside kind of deviation I'm going to face in my investment? To measure only downside risk, only the deviation going in the other direction, we have the Sortino's ratio. Okay. And here we only take the standard deviation, which talks about the fall in the prices, the decline in the value. only the decline. We're not talking about the positive. So the Sortino's ratio is only for the decline purpose and not for anything else. That is why you even see in the formula in denominator, in numerator, you have the same thing, RP minus RF, but in denominator, we have the downside deviation. So you will take into account all the areas where the market went down and it impacted that fund, it impacted the portfolio. And by how much percentage, what was the deviation of the decline that took place in that fund or investment? That will be measured by Sortino's ratio. And this is very important because people get scared. They want to know, how much will the market fall by, what will be the impact on their investments. I think people are more bothered about the loss rather than the profit that they would be making, and they're scared, they're panicked because of that particular loss. So I think it's good to even show them the Sortino's ratio so that they know, okay, this is what the downside is all about. I think that awareness will give them the confidence. So later, whenever the market falls, because ups and downs will happen, it will not create that panic situation amongst the investors because they are already informed about the downside risk. So Sortino's ratio for the downside risk, as I said, you will take only the downside deviation out here. Otherwise, everything else is the same. So portfolio return would be 12, 8, and the downside deviation would be 8%. Okay, so here you can see that there was still a 1 unit or a 1% of return which was generated for every unit of downside risk. So the investor will know that this is a potential, this company would still have to generate the returns despite the downside risk that is there. Any questions till here? Now I will share the whiteboard for another formula that you would want to learn. So now this was about more investing, about the funds, about investing in portfolios. But what if we have investments to be made in something like insurance? Of course, insurance generally we do not take it as an investment. It's more for the protection side. Yeah, I am sharing the whiteboard, guys. Please join that. You will be getting a link to join it. So as I said, we do not consider insurance from the purview of investment, but still, if you want to know, okay, how much are we actually getting it, what we can yield from that. So we can look at this ratio, which is called as the holding period return. It's a simple formula which will be applied. Now, holding period return is a very simple computation, but I would say that whatever value and maybe an anticipated value, okay, what I'm going to get at the end, the value at the end minus the amount that I have invested, the value at the beginning. And suppose during the period of my investment, I have got some dividends, I have got some additional bonuses, I can add that. Any kind of additional returns, I can add it. So this is the formula to calculate the holding period return, and this can be uniformly applied to any type of investment anywhere in the world because it's simple formula. If you don't have any dividends or any extra returns, you can remove that. You can just take the value at the end minus value at the beginning, divided with the value of the beginning, and you find the holding period return. This can be done for multiple years, like 8 years, 10 years, 5 years, whatever the period of your investment is. You can even use the annualized return. So suppose if you are finding for 5 years, so you want to know, okay, what's my annual return? So you can take the holding period return, you can divide it with the number of years. N stands for the number of years. That is what can be done. So this is how, guys, we can use the holding period return to do any kind of computation when we're talking about the investments in the market. And this is very simple. It's like a layman's technique. No standard deviation, nothing very complicated out here. Just simple substitution of how much you invested versus how much you got. So you will know, okay, this is a return that you have earned in these many years. Okay, I'll just give you one simple example. I think I'll have to And you all can note down that formula in the meantime. Just a minute, I'll just share my presentation. You guys, please clear these annotations because this will make it difficult for others to understand the question. Okay, so say Aaron
So,
has invested.
Sadaf,
Yeah.
so if you can reshare it, so automatically his annotation will go, and you can disable them as well in the setting.
So this is a very simple question. Anyone would kind of have this as a small transaction in the market where Aaron is our investor who has invested in a stock of a company. He bought that stock at about $50. He purchased around 16 stocks at that time. In about the beginning of 2023, we can assume that. And in about 2 years' time, since he feels he's got a good return, from $50, the price has gone up to 75, and he also earned some returns of $2.5 as a dividend. So therefore, he wants to know now what his annualized return has been like and what is the holding period return. So first, we need to start with the holding period return. So value at the end minus value at the beginning. Simple formula. I'm just writing D for dividends because there are dividends also here. Okay. Now, either you can take the per stock values, which should be easier to calculate. Okay. Or you can even multiply it by 16. We'll just take the per stock value. It will be easy to calculate. The answer will not be any different. You can even see the final answer would be more or less the same. Okay. Value at the beginning into 100. Can you tell me what is the answer for this? Can you all please calculate it? Yeah. You can write the answer in the chat box, everyone. For the holding period return and the annualized return, it will be considered as 2 years, the time period, the number of years, 23 to the end of 2025. Yeah. Can I have your answers in the chat box, please? 75 minus 50 plus 2.5 divided by 50. That's the computation. Come on, quickly, can I get the answer? Yeah, that's correct. So the holding period return is around 55%, correct? So isn't this a simple technique to calculate the returns for any investment that you've probably invested or you want to invest? Now, if I take this 52 and if I divide it by 2, I will get 27.5. So that means each year, Aaron has earned close to 27.5 returns. Like 27, 28% returns, which is extremely good. It's beating the market, it's beating the inflation, and there has been a good growth. Okay, generally good investments would provide you close to a 25, 30% return in a financial year, in a given year. Okay, so good investments can have the potential to give you that kind of a return. Everyone has got this computation? Any questions for this one? Easy, right? Simple formula and easy to calculate. So if you would have invested in something like US treasuries or bonds, the returns would have been just about 4% or 7%, 8%. They can't be more than that because they are completely risk-free. But if you take a little bit of risk of investing in a stock, you can even see with good companies, you can get like 27, 28% return. That's what this computation tells us. And this way, as I said, we can have many computations very easily being done, whether it is for stocks, whether it is for mutual funds, for any kind of investment, we can apply this formula. Okay, any questions here? Okay, now I'm going to share another PDF with all of you that's more on the lines to focus on the returns. We first discussed about the risk and returns. This is more focused on the return part. I'm just sharing it right away. So one very important thing is a compounded annual growth rate, which we call as a CAGR or CAGR, and these are the kind of terms that we use to understand that, what is the annual growth rate or the rate of return which is compounding in every single year. So here we have a simple formula where, say, this is the full form of CAGR, the CAGR or the CAGR is compounded annual growth rate. So say we put 10,000 in a 3-year fixed deposit, it becomes 14,000. Okay. So what was the compounded annual growth rate? So again, if you just put it in the formula of the holding period return, which we just said, you will get around 11.87. That means that there was steady growth each year. And obviously with the FD, you will not face any kind of ups and downs. You will not face any kind of a problem. Then we have the next one, that is the XIRR. That is a real rate of return. Okay, so what is a real rate of return that we have today, where you have 5,000 and say you're putting 2,000 after 3 months and 10,000, you're like kind of distributing it. You're not putting it equivalent. So therefore, see, this is how the chart would go. You're just dividing it and you're putting it throughout. So you would have in the first month 5,000, then 2,000 and 10,000. So this is how you could have like an actual annual rate of return. I'll just show you the XIRR formula that is not given over here. Yeah, I'm just sharing my screen for another website which you can use. It's a very informative for all finance concepts called as the Investopedia. I'll show you this video also if you all want, or I can share the link. So internal rate of return, the actual rate of return that we have, and how do we calculate that? I know this could be a little difficult or advanced in terms of a concept, but you will use this. Okay, so what happens is that whatever is the cost of that capital, that will be taken into consideration. And most importantly, what is the inflow coming in? And the cost of the capital will be the discounting rate, which will be putting down the value or reducing the cash flows. But ultimately, what is a return that we are generating? Okay. So this is basically the IRR would be like the cost taken into consideration versus the most important aspect is the return that we are generating. The cash inflow, the investment, and the internal rate of return. This is what we are trying to understand in terms of the IRR. So the net present value is a difference between the cash inflows, the investment that we are making. That would be the understanding with the net cash inflow. So this is for the IRR. As I said, this is a slightly advanced concept because here we need to find the discounted cash flows and things like that. But just for the understanding of concept, you can know what it is like. It's called as a real rate of return. Then we also have rolling returns. So rolling returns could be for like regular investments over the period of time, and what the investments would be like say, you're putting regular money in the mutual funds or the exchange traded funds. Regularly, you are investing in any scheme. You can calculate the rolling returns, how the money is growing, how the money is compounding. So people do look at these rolling returns, and on the basis of that, they invest. Also, let me tell you, like in the HPR formula that we did, that is also known as the absolute returns. Okay. So we have rolling returns and we have absolute returns. Point to point, it could be for a particular time frame specifically. Okay, because that would not be the same. Different people investing in different time frames, they could have a different timeline to verify, to find out what their investment has accumulated to. Okay, so point to point return. So you can see these measures which are there, the CAGR, your rolling returns, your absolute returns, all of this is purely for the purpose of calculating the returns. Okay, purely for the purpose of calculating the returns. And earlier, which we saw was a combination for risk and return. So as you can see, for a certain timeline. Annualized return, as I explained to you, even you can do annualized return for 6 months. It could be divided by 0.5. Okay, what we did, we divided by 2 in that example for Aaron's investment. But if you're doing for 6 months, it could be divided by 0.5. So it will automatically show the returns for 6 months. You're doing for 3 months, you can divide by 0.25. You're doing for 9 months, someone has invested, you can do for 0.75 as well. Okay, so these are the kind of different returns that you can use. Also, remember when you're talking about holding period returns and annualized returns for investing in real estate, it could also be a very valuable measure. Okay, as in the real estate, the tenure of investment could be longer for people. Like they could invest for even 5 years, 7 years, 10 years also down the line, maybe even more than that. At that time, you can use the holding period and annualized return. Total returns, very similar to the holding period returns that we learned. So these are different ways of understanding the returns which are there in the market. Now, talking about a very important concept also, which means or which focuses on the reinvestment. See, today we're talking about taking returns, but what are we doing with those returns? Okay, are we reinvesting them? Okay, I invested my money, I multiplied it, but what am I going to do with that? Am I just going to spend it? No, right? Maybe with the additional returns that I made, I want to reinvest that maybe in the same stock, which gave me good returns, maybe in the same scheme, in the same fund, or I want to reinvest in some new commodity that is there. Like as I said, you could reinvest it in gold, silver, copper. These are commodities which are doing and which will have very value for growth and potential in the long run. So, reinvesting is putting money into the same investment if it has given you a good amount, or withdrawing all of that money and reinvesting into another asset or another investment altogether because that has a potential for even a higher return. But what you do is you keep on reinvesting from one to the other and to the third one. So what it does is it's kind of building your corpus. It's kind of building your wealth. Okay. And that's what our objective is. Why have we all come here is to understand that through this risk return game, which is there, how can I accumulate wealth? How can I build wealth? Okay. And the most important thing you need to do while you're building your wealth is you need to have a well diversified portfolio which will balance the risk and the return. You cannot put a lot of money into assets or places where it's heavily risky. Okay. I would like to also show you one chart from the Harvard content. So this is talking about the mean returns, the annual returns and standard deviations of the different asset classes where it is lying. So you can see like on the x-axis, we're talking about the returns and on the y-axis, we're talking about the returns and on the x-axis, we're talking about the risk factor. So with the large cap companies, like you're talking about Apple, Microsoft, these are large cap companies. They are lying at about 20 to 22.5% of risk. But if you see in terms of return, they are pretty stable. They will be at between 10 to 12%. Small cap companies would be very risky. Okay, but they would provide again a higher percentage of return. Can you see on the risk side, they are much ahead of the large cap stocks, but they are providing much higher return also. Whereas if you see in the bottom of the chart, we have the corporate bonds, we have the US treasuries, the treasury bills, very low in terms of the risk, but very low in terms of the return as well. Okay, so this is where you need to have a well diversified portfolio where you would pick some corporate bonds, you would pick some US treasuries or treasury bills of your country, along with the small cap and the large cap. Obviously, given the age factor, the younger an individual is, the more potential the individual has to take more risk. So you could have more money parked in the small cap and the large cap stocks. But as you grow older, you might want to curtail your risk appetite and you could have more of your income diversified into lesser riskier assets and investments. Okay, so this is how you need to have a well diversified portfolio, which will all in all balance your risk and also ensure that you get a return. Plus, at the same time, it's helping you park your money for your emergency needs, for any liquidity that you have. It's also taking care of any kind of medical cost or medical emergency. Of course, we do have insurances for that, but in case if that does not suffice, definitely we will pull out some money from our investments. And the large financial objective that we have is every individual needs to look at their retirement phase. Okay, today this retirement corpus demand is increasing and increasing because of the high inflations that we have. Okay, so the younger I think people would retire, they would need a lesser corpus. The more older people retire in their life, automatically the corpus would increase because the inflation would increase and it would double up. So even looking at the very long-term goal of retirement, which could be 20, 30 years down the line, but it's important to kind of start early and keep on investing for the sake of the retirement as well, so that when you reach the retirement age, you have a good corpus which has been accumulated. Okay, so this also helps you to understand where different investments would lie in terms of the risk and return. So these are a few materials. I can probably even share this Harvard PPT with you, but it would have it has a lot of data points in it where it's telling you about the US market and what kind of returns have been provided in the last 10 years. You can have a look at it and maybe it will give you some idea about the growth of stocks, the returns, and the risk factors. Like this is a price chart for, again, 4 years for Microsoft, which is still one of the leading tech companies in the world. So you can see how this graph is more upward, which shows good wealth accumulation if people at least held this stock for 4 years. And this is like way back in 2012 to 2000, or 2011 to 2015. And lastly, I think I would like to also give you a little recommendation in terms of following news, as a Bloomberg business could be something which would help all of you in knowing about the current trends in the market, in knowing about what's happening, what's the future like, where the investments could be. Today, everyone's talking about data centers. That's where, is going to be the next investment boom. And I think by 2020, we are expecting that it's going to become another place where we could look at in terms of investments, which companies invest in data centers. So one of the portals that you can follow is the Bloomberg Business. I will just write it in the chat box also for everybody's benefit. Another one which I showed you is a portal, is a website. Also, it has an Instagram channel, which is the Investopedia. If you want any kind of notes, explanations, small videos, you can get it from the Investopedia. Very, very informative and again, very easy to understand. You want to know some advancements on the technology side, you can follow Business Insider. You can see the concept of smart cities, which is coming up, and the kind of investments which is happening there. Japan has Woven as a smart city project, which is coming up by Toyota. Saudi has NEOM, and you can see there are multiple in the country of UAE, the United Arab Emirates. So this concept of smart cities is coming up in a very big way, and you can see what future investments could be like in these smart cities. Yeah. So I think we can keep the forum open if anyone has any questions, and these materials I can definitely send to the admin team and they can relay it to you. Also, I'm mentioning Wall Street Journal is another Instagram and YouTube channel, Wall Street Journal and Financial Times. Financial Times has good documentaries, which you could probably see for some concepts and knowledge on the YouTube. Yes, thank you so much, everyone. Any questions anyone would like to ask?
Thank you, Dr. Sadaf. If you have any questions, please go ahead with it. Or you can put it in the chat box as well. I guess there isn't any. So thank you so much, Dr. Sadaf. And thank you, dear learners. Please do fill in the Google form, which is given to avail the recordings of the session. Thank you. Thank you, everyone.
Yeah, thank you, everyone. Thank you, Renu, and wishing you all the very best. Thank you, and keep reading and keep learning. Thank you so much.